Hello, dear traders and investors, and welcome to our third webinar of Investment Academy. And before we will start our webinar, let's recall the key moments of previous two webinars. Our conversation was about instruments and infrastructure of financial markets. Let's look at this picture once again. I remind that we have two categories of instruments, such as basic and derivative. The second one, such as futures, options, indexes, are derived from the first one. And we spoke about infrastructure, main participants, and their role in markets capital turnover. Now you know that there are two types of markets, such as exchange and decentralized market as forex. Each of them has own specific nuances and their advantages. In previous webinars, I've paid a lot of attention about market probability, and I urge, please do not forget about risk management. Capital preservation is a main brick of your financial success, your financial house. If you can control risk perfectly, the profits will eventually come. We will speak more closely at webinar 4 about controlling risks through diversification and timing. But now I want to capture this well-known chart from first webinar. Do you remember this chart? It's Nikkei 225. It's a composite index of 225 Japanese largest companies. Looking at this picture, just remember that anything can happen and all possible. Remember this picture, and you will protect yourself from excessive self-confidence and always take care of risks. And now, before webinar 4, we need to speak how to build your own financial plan. So today we have webinar 3 and theme how to build your own financial plan, investments or speculations. Before speaking about risks and diversification, we need to build the safest financial plan. Then will give us opportunity to invest money without substantial deterioration of life. Why is it so important? Because if trading or investigation is only source of your income, so it's a high probability of emotional decision in your trades and investments. Imagine you have only one source of income and it's an investigation in financial market. So let's look at this picture. For example, look at this picture. You examine S&P 500 chart and decided that the times of sharp sellers probably ended. But if not, your risks are limited. So you choose good timing and diversification and build market portfolio. You expect dividends and profit till the end of the year because you prepared your money reserve for 1 year and you decided to build market portfolio here. Good timing, good pricing, and you see that time of sharp sellers ended. Let's look at this picture. But economy recovering is not so fast as you expected, and index begin to fall. So your portfolio is in temporary drawdown. Thus, you expected to earn money, but you're now in drawdown, and you are totally dependent from the market because you haven't any additional sources of income. Even though you begin to think emotionally, you need money, you're afraid to lose more and forget that here you are not trader, you are investor. And what do? Of course, most likely you will break your rules and sell your portfolio to receive money and to stop suffering from the pain of drawdown. And as luck, in the next moment, market begin to rise. but you can do nothing. You violated your rules. And it's life situation, such as every month bills, payment for utilities, unexpected expenses that force you to earn when market is not suitable and forced to violate your rules. And instead of profits, you close your portfolio here. So that's why it's important to build your financial plan. It's a law of capital, and you need to know it. So your life expenses do not interfere your investments. You are not hurry, you follow your rules. Your profits from investments is reward for your clever financial plan and investigations. So now, I have a question for you. Do you have any financial plan? I often meet people who live just for today and don't think about future. Some of them do not believe in anything, nor investing, nor banks, nor money. They're thinking that financial world is a total fraud, and employment system is modern slavery, and there are no chances to beat the system. Their life credo, if they are feeling bad, so somebody is guilty. I think that they are potentially right. Yes, the modern economy is look like cheap money pyramid, but you can try chances, and you can be at the basement of such pyramid. Yes, the modern employment system also looks like slavery with unproportioned distribution, but you can try chances to find a way and how to control your risks and rising capital streams. What kind of benefits such people can receive when they simply stay and do nothing to improve life standards? What aim they achieve if there is no aim? You know, I like a conversation about aim between Cat and Alice from the book of Lewis Carroll, Alice in Wonderland. Would you tell me, please, which way I ought to go from here? That depends a good deal on where you want to get to, said the cat. I don't much care where, said Alice. Then it doesn't matter which way you go, said the cat. Now, let's speak more essentially. Firstly, all investors' risks are quite clearly defined during large financial history, simply following the logic that exists in inflation. We have a cost of real enterprises, assets, and on practice, the probability that everyone will be bankrupt almost zero. Look at this chart. It does mean that sooner or later, after drawdown, a new wave of growth will appear. Plus, you have dividend interest. Secondary, if you know your risks, if you have your financial plan, and your life expenses are not interfering your investments, it's a chance to work according your rule and to bridle your financial streams for your best. So, you need to create a balance of income and expenses to examine how much you can save for investing. Usually, when income and expenses too close, it's time to think what benefits you are willing to sacrifice today for much greater benefits in the future. More often, for successful saving and investments models, it's good when you're saving approximately 20 till 50% from your income. I need to urge that trading and even investing is a business. And such as in every business and in every profession, you need time and experience to understand all the nuances. So, first time you can face with losses. But if amount of balance is not interfering your life standards and you are losing a little while studying, it's okay. When you understand what are you doing, then you can rise investment percentage. The most fatal error here when you're on the beginner and you are trying to stake everything, all your savings. It's danger. For clear understanding of your aim in investments, you need to formulate objectives. First, defines your objectives for your first steps. Where to invest, choosing market, and how to invest. You can choose speculations or investments. Second, determine your balance between expenses and savings. It depends on your experience in financial markets. Try from little risk simply to study in rising risk when you have an experience and you could increase your capital. Third, do not forget about risks. How much you are ready to lose pursuing profits. It's very important to know. This risk should not be catastrophic for your capital and for your life. No any credit money. Remember, only preserving capital and controlling risks, you have chances for the best future. So, when you're trying to define the approach, investment or speculation, I can say that if you choose the way of speculative trading, so be ready for long and hard work. You need knowledges, you need experience, you need your trading system that clearly described in algorithm, and the most important thing is controlling your emotional condition. In practice, this is the most difficult, simply to follow your rules and to control your risks in speculative trading. I'm sure that speculative trading is the most difficult path to easy money. If you want to image the work of trader, so it's not something like lying at the beach with notebook as often you can find in advertising. The work of trader is every day preparing ideas before he will start to trade. It's hours of working with price charts, trying to find patterns. It's hours and hours analyzing your own mistakes, analyzing statistics, optimizing trading rules and mathematics. And you need to know, as an active trader, you can only predetermine numbers of profits and losses if you have at least 200 identical deals. Only identical deals give you an opportunity to find statistical patterns and to build mathematical model. When you will know drawdown of your trading system, so then you can calculate the maximal risk. You know percentage of winning deals and you can predetermine the amount of profits. But before you will accumulate statistics, you need to build your trading system with core idea and advantage. Without such hard working, trading will be something like casino or gambling. And your second choice can be the way of investing, where you can think how to divide your capital with minimal risk and higher probability. So, as investor, you need to know main criterions of safety, for example, such as reliability of banks and banks country. If you invest in the asset manager, his drawdowns, leverages, and profitability examined by time. Then more time the account of asset manager exists, then higher probability of his stability in the future. My remark for those who think the world of finance is a fraud. I'm deeply sure that sitting and doing nothing, it's 100% guaranteed that you will not receive better profits and always will stay at vicious cycle. Of course, you have risks investing your money and no guarantee for immediate big profits. Someone who promises you big profits without risks simply lying to you. But you can beat profitability of banking deposits and banking instruments with clever investments and diversifications, controlling your risks at the same time. As in fairy tale about Alice, the choice is yours. So clearly formulate your aims. For example, money for pension, buying house or apartment, child's or your education, etc. When you clearly understand your aim, then you can certainly define value of savings and balance between income and expenses. Let's look at this simple example of very conservative savings. Here you can see balance between income and expenses. Of course, it's individual for each person, and this is only example, simply to show how it works. For example, the average income $700 and we decided to save 30%. This amount is personal and it's maybe more. So in this example, we saving 30% of our income every month. I can say that 30% is very comfort value of savings that do not interfere much of our life standards, and we have chances to build clever investment program for our future aims. Then we decided to work conservative. So 50% of our savings we will divide in two instruments: banking instruments and asset managers. Okay, in our country, the average of banking deposits in US dollars is approximately 5.5% per year. Thus, let's calculate. Our invested sum of 1,260 US dollars with a reinvestment will lead to total savings plus profits with 1,298. You see this calculation. Amount of first deposit when you start to save for banking account, its total sum of invested money and annual return with reinvestment and savings plus profits. And second part, we invested into asset managers here. Okay, let's see. Let's calculate. Numbers and risk are individual for each other, and we will speak more detailedly how to diversify in next webinars. But here an example, average example. And let's look average example with 20% risk and 40% profitability. So we can expect till the end of the year with reinvestment to receive 291 US dollars, and our total saving of second part will be 1,551 US dollars. You see, first amount from our savings into asset manager 50%. This is sum of invested money from savings annual with and annual return with reinvestment and total calculation. As a result, we have total savings per year are 2,520 US dollars and interest with 329 US dollars with risk 10% from our total capital. Why it's 10%? It's simple. We had 20% risk for investments in asset managers. This 20% risk is from second part here, but in total capital it will be only 10% because second part is only 50% from our total savings that we invested, and 50% we of course invested into the banking system and 50% into asset managers. It's very conservative approach. In conclusion, I've given an example of how important time and patience. In this case, we are talking about investments, but it's also touched speculations. As I mentioned, our conservative diversification among bank deposit and asset managers will give us numbers in this example at 13% of profitability. If we have an aim over time to convert, for example, invested money into an asset, so let's look at this chart of compound interest of such investing after 15 years. Only clever investments that imprudent expenses will lead us to our aim. Of course, we can quicken this aim, but it will relate to higher risks or higher profitability. Thus, you can choose different types of investing with larger volume of savings, but to take away your profits from asset managers every month. The idea of such approach is to invest more, of course, expect more, and to cover risk as fast as possible. For example, you calculated that average profit of selected asset managers approximately 5% per month without reinvesting. So you are investing 1,000 US dollars and you can expect whole return after 20 months. This money you can invest then into banking account. So you are in perfect safety after 20 months. Those simple examples clearly show great numbers of choices of safety investments. And it's your choice how to act. And I hope that this webinar will help you to make the choice carefully, competently, and safely. I wish you good day. Thank for your attention and see you soon at next webinar.